This is the frantic trading floor that many beginners associate with the stock market, a loud, confusing environment driven by split-second decisions and unpredictable daily swings. Building long-term wealth does not actually require you to navigate that noise. Successful investing relies on disciplined, rational decision-making rather than guessing games. This is Benjamin Graham, captured here carefully analyzing a financial document. Graham wrote The Intelligent Investor, a foundational text for evaluating businesses logically instead of reacting to market hype. Today, we are going to translate Graham's theoretical principles into a concrete, step-by-step, first-time investor blueprint. Go ahead and grab a pen and a piece of paper. You are going to build your own personalized portfolio plan right now as we work through these steps together. A documented, disciplined system manages risk and accounts for human emotion when the market becomes volatile. Step 1 starts with defining your goals and your timeline. This separates the intelligent investor from the speculator. A speculator treats the market like a casino. They attempt to turn a quick profit by betting on short-term, daily price swings. An intelligent investor focuses on the long-term intrinsic value of a company. They look for steady business growth and rely on reinvesting their dividends over time. Write down Step 1 on your blueprint. Establish an investment timeline of 10 years or more. If you need this cash for a house or a car in under 5 years, keep it in a savings account. Extending your timeline is the easiest way to eliminate the distracting noise of daily market fluctuations. Now we apply Graham's core foundational principle, the margin of safety. This diagram shows how the margin of safety works in theory. Intrinsic value is the actual calculated worth of a company based on its assets and earnings. If you buy a stock at a market price significantly lower than that heavy intrinsic value, you create a protective cushion. This translates directly to your personal finances. You must separate essential living expenses from investable cash. For Step 2 of your blueprint, calculate and write down a specific monthly investment budget. Use only the disposable cash left over after your bills and emergency savings are fully funded. Securing this personal margin of safety ensures you will never be forced to panic sell your investments at a loss when a personal emergency collides with a market dip. Next, we address a common beginner mistake, putting all your capital into a single company stock. Look at this grid. Diversification is the deliberate strategy of spreading your investments across multiple companies and economic sectors to mitigate risk. When properly diversified, a loss in one specific sector is naturally offset by the stability and growth happening simultaneously in other sectors. The most efficient tools for achieving this are broad market index funds and exchange-traded funds, ETFs. An ETF is a single investment asset that automatically bundles together hundreds of different stocks. Write down Step 3 on your blueprint. Use diversified ETFs as your core asset strategy. Utilizing ETFs removes the impossible task of picking individual winning companies. You simply place your bet on the long-term growth of the overall economy. To protect your new portfolio, you have to understand a psychological concept Graham called Mr. Market. Imagine you co-own a business with a highly emotional partner. Mr. Market has wild mood swings. During optimistic greed, he demands high prices. During pessimistic fear, he offers to sell his share for pennies. Unprepared investors mirror Mr. Market's emotions. They buy high due to FOMO and sell low when panic hits. For Step 4, write down this strict behavioral contract. I will not let Mr. Market's emotions dictate my actions. I will hold for long-term growth. Market dips are never emergencies to flee from. They are simply periods of temporary pessimism from Mr. Market that intelligent investors calmly ignore. Review your completed first-time investor blueprint. You have a 10-plus year timeline, a safe monthly budget, a diversified ETF strategy, and an emotional defense plan. You have replaced the anxiety of guessing with the confidence of a structured, intelligent plan. Now take your written blueprint, log into a secure brokerage account, and make your first purchase of a broad market ETF using your exact budget. Once you have officially made that first investment, drop a comment below. Be sure to subscribe and like the video so you can return to these rules whenever Mr. Market acts up. Wealth in the stock market is built by practicing patience, maintaining your discipline, and trusting your blueprint.